And the next functional category that we're going to cover in this part of the lecture is the one of financial derivatives. So this is the overview for the functional category of financial derivatives, and we are going to follow a similar structure as we did previously for the functional category of other investment. But there are two crucial differences here. One is that there is no income by convention on financial derivatives, so we're gonna not talk about this. And the other part is that instead of the breakdown for this functional category, we're going to focus a bit more on the topic of significance of financial derivatives in the balance of payments and the IIP. We're going to start with financial derivatives in the BOP or IIP. And as I already mentioned or explained before, this is the system of accounts for the external statistics with the opening and closing balance sheets and the transactions and other changes over time. And all the other financial functional categories in the financial account are actually somewhat similar in the sense that they appear everywhere in the opening balance sheet, in the closing balance sheets, exchange rate and the other changes, price changes and other volume changes, and also have a primary income. Financial derivatives actually somewhat reduced. For one, there is no primary income or investment income on financial derivatives, and also that there is no, by convention, there are no exchange rate changes for financial derivatives. We're going to talk about this a bit more in the next segment. So now let's have a look at the numbers of financial derivatives. And in this case, we're going to look at the numbers for Germany, and these are taken from the Bundesbank statistical series. And this table on the left-hand side, you see the transactions that show a change, or transactions in assets abroad from point of view of Germany. And on the right-hand side of the table, you see the transactions in liabilities abroad from the point of view of Germany again. And these go back, or you see the time frame goes back until the year 2005. And now you see the transactions in financial derivatives here, and you notice immediately there are only transactions in asset and no transaction liabilities, or to be more precise, actually, financial derivatives only show net transactions. So we have to keep that in mind if we compare these to the numbers in other functional categories. So for example, it's the higher, the transactions are higher in the year 2020 compared to direct investment transaction assets. But you also have to take into account that direct investment also has transactions and liabilities. Why is this the case for financial derivatives? We're going to see a bit about it, but one point is that financial derivatives can actually change from derivative positions from assets to liabilities and vice versa, and therefore the net presentation is acceptable because it makes more sense in that respect. And in general, Germany has a tendency to have a positive net balance on financial derivative transactions. And also you might notice that in the year 2020, we have a bit of a special effect taking place. And this means, or what is the background here, is that there was a restructuring of firms internationally, and some firms shifted around, and therefore we now see a higher net balance in financial derivatives in Germany in recent times. So after we had looked at the transactions for Germany, now let's also look at the international investment position of Germany and the financial derivatives influence on this. And you see this here again for previous years highlighted. And we have in the upper part the assets in financial derivatives and the liabilities down below, and then the net balance in this functional category. And as you can see, the development of the asset position of financial derivatives is actually increasing, and the same is true for the liabilities in recent years. The balance actually is rather consistent. So sometimes it's minus 30 billion, sometimes it's minus 15, and but it doesn't show a clear trend. So although Germany has this positive net balance in the transactions, as we've seen in a slide before, the overall net balance in the assets and liabilities positions doesn't show a clear trend due to the valuation changes in the functional category of financial derivatives. And as before, here you see a list of articles or paragraphs in the BPM6 where you can find information or statements or rules about the role of financial derivatives in the balance of payments and the international investment position. Again, or take note that financial derivatives is a rather new kind of functional category compared to FDI or portfolio investment, and also compared to other investment is not as far encompassing, and therefore there's less entries maybe at the current point than the other functional categories. So now that we have done this broad overview of financial derivatives, it's time to go into a bit of more of detail, and we will look now at the financial instruments that make up this functional category. To do this, in order to do this, we will first have to get a better idea about what actually financial derivatives are, what they're used for, and then we can see what kind of financial instrument are used to or make up the functional category of financial derivatives. First of all, the question is, what are they used for? And very short way to put it is basically financial derivatives is a tool or is an instrument to trade financial risks. What kind of risk are we talking about? You can see the list here. All kinds of basically. There is interest rate risk, there's foreign exchange risk, there's equity price risk. The commodity market can use financial derivatives, and you can use credit risk. And what is meant by trading? Well, the two main purposes in this case are hedging and speculation. On the one hand, if you believe that the equity price is going to increase and you want to invest into this, you can buy the equity, but you can also use the financial derivatives to profit from the increasing price and obviously also take losses from the lower price. The other point is hedging. That is the other motive used that financial derivatives are used for. If you believe that the equity price is going down, you can use a financial derivative to actually hedge yourself against potential losses there. And that is the way that you trade away the market risks in this category. In this case, you would sell it, someone else would take it, and you would be free of this risk. And you can also buy it, and in this case, you would be speculating. So what is particular about them? Why are they called financial derivatives? Well, the financial derivatives are called, have this name because their value is derived from an underlying asset or price. This is basically depending on which risk you take or which risk you want to trade. If it's an equity risk you want to trade, the underlying would be an equity or a stock. If you want to trade the risk of a currency, then the underlying would be a currency, and so on. And the other particular thing is that financial derivatives have a very low level of investment to get into the market, but a very high basically loss potential. So they basically, or what is written here, there's a very high leverage involved with financial derivatives, which makes them rather volatile as a financial instrument, and therefore also as something worth keeping in mind from the point of view of supervisors and so on. There's a high degree of contractual freedom, while if you buy a stock, there is only a certain part that can, of the contract of this asset, that can be negotiated, while financial derivatives are basically free financial instrument, and you can always, or there's always the point to talking to the other side what special effects you would like to have in that financial derivative. You have a counterparty risk, obviously, as well with financial derivatives, in the sense that, like, if the other party, if you buy a financial derivative from someone and the other party goes bankrupt, that is on you, and that is a valid point that you have to keep in mind. And also something that supervisors have been aware of. And finally, the pricing of financial derivative is very, very complex. In the 90s, there was a Nobel Prize for a model of financial derivative pricing by Black and Scholes. And this is still something where a lot of research is going on, how correctly to price financial derivatives. Obviously, price is built on the market, but from a point of view of investor, you would like to know if this is an appropriate price or if that's too cheap or too expensive. What determines the value of financial derivatives? Talking about pricing, well, first of all and foremost, I would say, is the price of the underlying asset. Mentioned before, that can be a wide variety of things, but that we would expect: shares, interest rates, exchange rate, commodities, and so on, indices, very common, freight rates. But I also said contractual freedom is given with financial derivatives, so you probably can also find financial derivatives on obviously credit events, so default of a company or a country, but also more obscure things as weather conditions and so on. And again, the list can be extended quite substantially. So the next question is, what types of financial derivatives exist? And there are basically, although there is a wide range of financial derivatives, there are three broad categories or broad types. First of all, there are the forward types financial derivatives, and what this means is that there is an agreement where the seller-buyer has the obligation to deliver or pay for an asset at a fixed price at an agreed future date. What does it mean? There's an underlying certain asset that you agree on with whoever you do this forward agreement with, and one of you is the seller and the other one is the buyer. So let's say there's a certain amount of stock of shares in like a certain amount of time, 6 months or something, and by that time you agree to, for example, deliver 100 of these shares of stocks to a certain price that you agree now, and the other person agrees to then pay this amount of money. From a point of view, you can again trade the risk away by agreeing already price in the future that you know will hold then, except for the counterparty risk, and the other person knows by then that for certain, except for the counterparty risk, this party will get the shares of stocks. Likely what you can do with this is, for example, if you have a certain commodity coming in 6 months' time, you can also fix in now the price you will get for it. Or if you need it in a certain amount of time, you can already now fix the price that you will pay for it. The next thing is an option. And in this case, there are two types. There are call and put options. And one is the right to buy something. The contract gives you the right to buy something at a certain point in time or up until a certain point in time on a fixed price. And the sell option, the put option, is basically the sell option where you can sell something up to a certain point in time or at a certain point in time, depending on the type of how the option the contract is done, for a fixed price to the person selling you the option. And the difference to forwards is that the option is the right but not the obligation to do this. And obviously this is an asymmetric contract in the sense that like one person buys the option and then has the right. The other person or the other side sells the option and then has to basically go with whatever the buyer of the option wants to do. If the buyer of the option wants to perform the buy or wants to perform the sell, the other side has to do this as well. The difference here is basically that the buyer of the option pays. Next thing is, how are they traded, financial derivatives? There are several types. Again, first type is exchange traded. The second type is over-the-counter traded. And basically, if you have an exchange traded derivative, there's already a certain degree of standardization. You have a higher degree of liquidity at the exchange. There's more transparency, and basically due to this happening on an exchange and a lot of people being involved, there is no counterparty risk, or basically not existing there. On the other side, you basically are limited to what is offered on the exchange. So it's mostly futures and plain vanilla options. On the other hand, if you want a more customized deal and have especially money around for this, you have the over-the-counter dealings, where basically you agree with the other side about specifically what kind of derivative you want to trade and can customize this to your liking. There you have obviously all the things that you didn't have with exchange rate. You have a kind of liquidity risk if the other party is liquid. You have the counterparty risk there, and by now also you have the tendency to have that cleared via a central counterparty, CCPs, at least in Eurozone, due to otherwise the financial risk not being too high in the sector. So basically, if that is cleared via central counterparty, you know where to look for these over-the-counter derivatives to a large degree from the point of view of a supervisor. So now that we covered the financial instruments, what financial derivatives are and how they work and what is special about them, the next step is what we're going to look at is the actual significance of financial derivatives. Since it's a rather new category and the numbers with the net presentations are a bit deceiving, the question is how far are they significant and how far do they matter in the grand scheme of things. What we see here is again the presentation for the Eurozone from the ECB Statistics Bulletin. And the point of view is, first glance, obviously, if you compare these numbers with just these numbers, which are more in trillion area, and this is a billion area, on first glance, that seems like, okay, why do we bother with this? But on the other hand, what I already mentioned, this is the net presentation, so obviously you would have to compare the difference between assets and liabilities with this number. And even then you see that the difference in the positions is rather substantial, or that is a different category compared to these roughly negative 100 billion in the net financial derivatives. So let's talk about, are they significant, although the numbers don't necessarily look like it. The financial derivatives have actually been featured in the news quite a lot and have been responsible, or have been played a role in several events with recent times. They have played a role during the global financial crisis, especially for the cases of Lehman Brothers and AIG back in 2008. They have more currently the use of a special kind of derivative called total return swaps. They have been a case of Arceus. I'm not sure if I pronounced this right. And played a role there. So they have been, due to these events, been the focus of regulators. But since financial derivatives are so versatile, since there's so much contractual freedom involved in them, and especially in OTC derivatives, they have been a focus of regulators. But also in the case, it's not easy for regulators to keep track of what's going on, and it's easy to accumulate a significant amount of market risk with financial derivatives, or it's easier to compare to other financial instruments to accumulate a significant amount of market risk without showing up in statistics right away. So let's take this brief detour to financial supervision. Actually, there's a current project going on in Europe, is the European Market Infrastructure Regulation, and the goal is there basically to also have a view or to keep track of OTC derivatives. So if you exceed a certain amount with your business deals in OTC derivatives, you actually have to clear it through a central counterparty. And also there's a mandatory reporting of all derivative contracts to trade repositories with a certain amount of information you have to give about this. And the European Securities and Markets Authority is responsible for surveillance of trade repositories to keep track of this. Since, as I mentioned up here with the global financial crisis, financial derivatives have played a role in several cases where heavy losses occurred later on due to positions in financial derivatives. And then we're going to conclude this functional category by looking at the valuation and compilation of financial derivatives. First of all, what are the rules for transactions? As we discussed already, is net reporting of transaction is accepted and is heavily used by convention. And also what I pointed out before, there is no primary income, or let's say investment income, in financial derivatives. There's one link to the primary income account due to if a company offers employment stock options, which is the other part of this category, which is a derivative on the stock of the company for the people working there as a part of a salary. In general, this is something we could spend a lot more time on, but I have to condense it to this point here. Transaction financial derivatives are actually whenever you basically have something that increases or reduces your asset or liability position you have to report it as a financial derivative transaction. Obviously, if you deal in financial derivatives, what can this be? That can be a difference payment at settlement. If you pay an option premium when you buy an option, or if you get one, the thing about is, if you pay an option premium, you actually have an asset because you have this option. And if this option is settled at the end, and then you pay this difference out, or you get the difference payment out, if you get the difference payment out, your asset is reduced. So if you have future variation margin, is basically if on a given day your position ends at the end of the day being a positive, so it's an asset for you, and the counterparty pays you this amount, this is settled, this liability of the other side is reduced, and that is something that you have to report as transaction. On the other hand, if you have a kind of margin deposited as security, as I said, the name deposited, basically that would be a repayable margin that is just posited there as a collateral. That is something that does not actually increase or reduce your asset or liability with a financial derivative, but rather is a separate asset and therefore has not to be reported under financial derivatives. And talking briefly about the links to other accounts, there basically is none, except for one case. If you have financial derivatives associated with reserve asset management by a central bank or monetary authority, these are part of reserve assets, as is written in BPM 6. Everything else, all other financial derivatives, are in the functional category of financial derivatives. Even if you have a financial derivative that is sold by a direct investor to the other direct investment company in the same multinational enterprise, this will still be in the functional category of financial derivatives and not be in the functional category of foreign direct investment. Then let's take a look at the positions, the rules for the valuation and compilation of positions in financial derivatives. In this case, we have gross reporting, so we have a separate reporting of assets and liabilities for financial derivatives. You might have noticed this already when we had a look at the numbers. And these positions have to be reported at market values. Notably, a position in individual financial derivative contracts can switch between being an asset and liability for a given counterparty. So if you have a forward contract with someone else at one point in time, this can be in a position that is an asset for you and a liability for the counterparty. And a few days later, given the respective market development of the underlying, it can be a liability for you and an asset for the counterparty. And in this case, this individual position would switch from being an asset in the external position in the IIP from the country of your residency to being a liability in the country of your residency in the IIP a few days later. Next thing is, as a convention, financial derivative positions are not affected by exchange rate changes. This is written a bit differently in BPM 6 in the paragraph 9.31. But nonetheless, the convention nowadays, if you look at the presentation, is that financial derivatives are only affected by market price effects. So you will not see any statistic telling you how the exchange rate effects affected financial derivatives, but only basically have a report on the market price changes. And again, as similar or same as with transactions, financial derivatives are always in the functional category of financial derivatives unless they are used in the management of reserve assets.